Welcome, and thank you for joining us. You're listening to The Educated Investor. On this podcast, we'll not only cover current events, but also ideas to help you possibly maximize your Social Security benefits, manage your taxes, and overall become a more educated investor. And now, here's your host, Jerry Blakely.
Well, welcome everybody. So glad you are here today on the Householder Group's Educated Investor Podcast. And I'm visiting family in our condo in the Stallion Springs, Tehachapi Mountains between Bakersfield, California and Lancaster, California, north of LA County. It's the land of four seasons. It's beautiful weather. Fall is turning into winter. And it made me think of year-end reflections, housekeeping for visiting guests, in a time of Thanksgiving or giving thanks. So today, what I'm going to be talking about are some financial housekeeping ideas that are basic but important, but things that are seldom thought about or even talked about by most families. And we're going to approach that holistically over what we call the 5 key areas of financial planning. And I'm also going to be talking about thanks gifting with qualified charitable distribution. So those two topics, and we're going to start with the 5 key areas. So the 5 key areas have to do with a holistic approach to financial planning. And the 5 key areas were delineated or defined by the Certified Financial Planners Board of Standards a long time ago. And they say that there are 5 areas: estate planning, insurance planning, cash flow, income planning, tax planning, and then investment planning. And these 5 areas are integrated. They all coordinate one with the other. If you change something in one area, that affects the other areas. And the concept there from the CFP Board of Standards is when you do financial planning, just keep in mind, like, it's not about how much money you have on paper or picking the right stock or mutual fund. It's what you and your family get to keep after all the risk of loss of your money from inflation, from taxes, from things you could buy insurance to protect from, and from the fact that one day, I'm sorry to tell you, but you probably know this already, you will die. So the holistic approach of the 5 key areas of financial planning has to do really with trying to do 3 things. One is growing yet protecting your wealth. The second is to legally reduce taxes whenever possible. And the third is keeping it all in the family when it comes time to pass. You don't lose it all in the IRS or the courts. So hopefully you're working with advisors who have a fiduciary standard of care, which is a legal mandate to put the interest of you first, and who have experience with applying holistically and the coordination of these 5 key areas, like the advisors at Householder Group do. But I want to start talking about each of these 5 key areas. So I want to jump into estate planning. And again, these are things that are kind of basic, but I'm going to touch on some items that are not the normal thing you hear about or might not be aware of. So with estate planning, and this is not a total dissertation on estate planning, I just want to cover on a couple of areas. And what comes to mind for me, if you're doing financial planning, housekeeping, end of the year reflection, making sure things are okay, kind of like a New Year resolution, but it's at the end of the year. In the 5 key areas with estate planning, I want to mention titles and beneficiary designations. Not too many people are aware and think about this. You think it's all going to be okay, but you got to understand that when you pass, the institution, the people holding possession of your money, like an IRA custodian, a 401k custodian, or in real estate would be like the county recorder's office. Who's the legal title? Who does this thing belong to that you passed away? And since you passed away, you can't own it anymore. It has to go to somebody else. And if you don't have clearly by law indicated before you passed away who the next person is, the beneficiary, co-owner, something like that, there's probably going to be a probate. A probate is a court proceeding where a judge says who gets the stuff next after you're done with it. Because if the people holding the money, like the IRA custodian, don't know who to give it to, you didn't put it in writing in a legally acceptable format before you passed on their system. That's called a beneficiary designation. If they don't know, they're going to ask the judge, who do we cut the check to? Who are we supposed to figure it out? Like if you put all my children, they can't cut a check to all my children. It has to be people's names. So the people with the money, you know what I like to say on this concept of probate and when you pass away, who's supposed to get the stuff and all that? is kind of an estate planning definition, a new definition of the golden rule. Everybody knows the golden rule, do unto others as you would have them do unto you. In estate planning, the golden rule is kind of the concept of he who holds the gold makes the rules. So think about that for a minute. What do you mean he who holds the gold? Well, if you pass away, there's $1 million in an IRA account. There's a thing called an IRA custodian. Whatever company is in charge, of holding that money, they can't release the money to somebody else. They make the rules. That's actually the IRS and the law system of succession planning and so forth. They make the rules, but the custodian has to enforce it. So if they don't know who to give it to, you're going to have a problem. So here's the point. With beneficiary designations, I'll keep it real simple. Make sure you have, and you can check this, online or in your statement or call the 800 numbers or whatever. I suggest documentation. How do you have the beneficiaries designated on those various accounts? Roth accounts, 401k accounts, TSA accounts, even life insurance accounts, those kind of things, annuities, anything that has a beneficiary designation. That's the formal word, beneficiary designation. And what do they think in their records is the first person in line? If you passed, who's supposed to get it? Because those type of accounts, retirement accounts, have a beneficiary. The thing passes by beneficiary. So if you put my spouse, they don't know who the spouse is. It has to have a name on there. But here's the thing that most people miss. What if you and the first guy in line, the primary beneficiary, what if you pass away in a car crash together? So here's the question, who's the second person in line? That's called a secondary or contingent beneficiary, contingent on the primary being gone. Who's next in line? You got to make sure each account has a primary and a contingent beneficiary on it. So that's one thing to do some housekeeping on. It's a perfect time to be thinking about that with holidays and family and so forth. And on estate planning, avoiding probate would be real estate titles also. Real estate titles and accounts that don't, like investment accounts, stocks and bonds, that don't have beneficiaries because they're not a formal retirement account under Section 401k of the IRS code. That they're not formal retirement accounts. They're like individual accounts. You just own it yourself with no particular, tax wrapper of an IRA or something. Typically, it's in an individual's name. So you could put a joint ownership, like this, make it you and somebody else's name. You both own it. But remember, the other person then, if you pass away, they own it completely. But the other person, if it's joint, they have the right, they own it. They can take the money too while you're still alive. So if it's a spouse, that's how most people do it, joint ownership. But you got to worry about this. What if you both pass again? So both joint owners are passed away. Who is going to be next? And the primary way to do that is to get a living trust that says who gets what when, and you retitle the asset to it being owned by your living trust. People confuse this all the time. There's a famous thing going on right now. Well, not right now. It's in the news here a couple of months ago with Michael Jackson as an example. So when Michael Jackson passed away with his large estate, he had a living trust, but everything went to probate court because he didn't retitle his real estate. He didn't say that the real estate is owned by the living trust. So they have to go to a judge and say, what do we do now? Because the house was not in the trust. So that's the idea. Get the titling down correctly on those type of assets that don't have beneficiaries. There's a thing today now, kind of a newer law. You can, if you don't have a trust, at least do a POD or TOD, payable on death or transfer on death. It's like making a beneficiary on these non-retirement accounts that don't have beneficiaries. So that's my housekeeping for estate planning. So 5 key areas of financial planning. They are estate planning. We're going to go to the second one, which is insurance planning. Then we'll do cash flow or income planning, tax planning, and then investment planning. So let's do item number 2, insurance planning. So I want to go beyond the basics of most people talk to financial advisors, and you understand that you've got to have, some concept of protecting against the risk of long-term care. Today, we live a long time, and all the expenses to keep going if you live too long can drain your estate because medical insurance will not pay for the expenses, the custodial care of long-term care. So that concept is there. There's, of course, life insurance, and those things, most advisors and most families are talking and looking at that. I want to talk about a couple of areas that most people don't talk about. And one is this idea. What's the deductible on your car insurance and homeowners insurance? Like if you crashed a car, how much do you have to pay out of pocket before the insurance company kicks in? And a lot of people we talk to, affluent families and so forth, they have a low deductible because, they didn't blink an eye, whatever the cost was. They say, oh, yeah, $250. That's the lowest deductible. But here's the question. If you are one of these affluent families that I'm talking about, you probably have cash reserves. You have available money in the bank account, just for a place to put money, except for cash reserves. It's not very high interest and so forth, but you have cash reserves sitting around that if you had an emergency, you could take that cash out to pay the emergency. So if that's true, why don't you ask, as a financial housekeeping item, ask your car insurance guy, your agent, would it save you much money, premium dollars, the cost of the insurance, if you raise deductibles? Can you raise it to $2,000 or $5,000? That probably be a substantial saving on your car insurance. Now, of course, as soon as you do that, you might have a crash and then well, thanks a lot, Jerry, for your advice. Where am I going to find $5,000 to pay the deductible? Obvious answer, in your cash reserve. That's what it's for. So if you don't crash your car a lot, there's an idea for you to go looking at. The other thing is something not too many people understand at all. It's the umbrella liability. Now, let me talk about this for just a second, and I'll try to make it as simple as I can. Liability insurance means if you hurt somebody else's property or their body, and you're liable for that because you caused the hurt. So a car crash, the typical thing, a car crash. So it's your fault and you caused the car crash and somebody got hurt, messed up their car or ran into their house or whatever. But, you say, well, call my car insurance company because I have car insurance and they have that liability on there, bodily injury, property damage liability. And the problem with that is that those are usually limited to 500,000, sometimes $1 million, but I've never seen it. The liability coverage on a car insurance policy or a homeowner policy higher than that $500,000 or $1 million. So the problem becomes that in a court of law, if you hurt somebody and they want, $10 million to fix the problem because you hurt their body and they got brain damage or whatever the problem is that you caused, they want $10 million and you don't have $10 million. They can't get $10 million from you. They can't get more than all you got, but they could get all you got minus the insurance. So pretend you're worth $3 million and you're caught in a lawsuit, civil litigation, bodily injury lawsuit. And you say, well, call my car insurance guy. And the car insurance guy, no problem. We will pay $500,000 of the judgment. The court's going to say, you're worth $3 million. That's how much your net worth is. So we'll take all of your net worth minus the $500,000 from the car insurance. That's how it works. Now, if you don't know net worth, it's a pretty simple concept. Take a piece of paper or your computer or something and write down how much you think everything you got is worth. Itemize it. The 401k is this, the house is this, my rental is this, and then subtract from that any debt on it, like if you have a mortgage or something. So what do you got minus what you owe? That's your net worth. That number, you should have liability insurance coverage for it. The problem is if you call the car insurance guy and say, I'm worth $3 million, you told me the car insurance is only going to cover me for $500,000 if I hurt somebody's property or body. So I want you to increase the liability coverage on my car insurance. And the answer is they cannot do that. They can't raise it up. You're at the highest on that policy already. But there's a concept, there's an insurance thing out there called umbrella. And a picture an umbrella, keeping the rain off whatever's underneath the umbrella. The umbrella is the liability policy that covers the underlying policies. So if you buy an umbrella liability, and by the way, they sell umbrella liability policies in $1 million chunks. You buy $1 million, $2 million, $3 million. And per million, get this, it's very inexpensive. It's about $250, $300 per year per million. So my family with $3 million, like if that was your net worth, let's see, 3 times 3, that's 900. For less than $1,000, you could protect your estate from this type of a thing, where you thought you're going to retire okay, but you got tagged in a lawsuit and lost your net worth because you didn't have umbrella liability. So those are my two pointers for a financial end of the year financial housekeeping that most people don't think about and talk about. A good time to be looking at those. So a holistic approach here to financial planning is these 5 key areas. Let's go on to number 3. Let's reiterate: estate planning, insurance planning. Number 3 now, cash flow and income planning. And then number 4, tax planning. And number 5, investment planning. Let's cover the cash flow. And here the concept, of course, is to be proactive. You should be proactive. And here's the little wrinkle that most people don't think about. What is your after-tax spendable income? So you can usually pretty well count up where and how much the money coming into your life is coming from work, from Social Security, from your IRA distributions, whatever it is. So how much is coming in, but you got to predict about how much tax will be on that, because not all the income coming in is taxable. So there's a way to do that. If you're doing TurboTax or asking your accountant, if you don't know, depending on your state and how much money you have and so forth, that's, I don't know, rule of thumb safe to take off 20 or 30%, 25% or something, in taxes, income tax between the state and Fed, depending on what state you're in. But whatever's left over, that's how much you can spend. Now, this is critically important for seniors, or let me say people who retired. People who are not putting money away in the accumulation phase of their life, but they're now taking money out of what they've saved up they're in the distribution phase of your life. It's like you've got, the fixed income scenario here. So a couple of thoughts regarding cash flow and planning your income. And I'm thinking about Social Security. So these are some things to think about with Social Security, whether you're in that 60 age group, or you can start social at age 62. You can start it at age 60 if you're widowed. You can do different kind of things with ages. But one of the things to consider about, to think about and consider is your Social Security income going to be taxable? It's going to be reported on your tax return, but here's the rub. There's a formula. It's not too hard to understand, but I don't want to cover it here in this podcast because there's other things I want to talk about also in the other 5 key areas. There's a formula that says you can kind of predict, is none of your social going to be taxable, even though it's on the tax return, it's not taxable. Or the other level is half of your social is going to be taxable. Or you've got so much other income on your tax return that they're going to tax 85% of your Social Security, not 85% tax rate. It's just 85% of your social income is going to be taxable. So that's something to be thinking about, is your Social Security income could be tax-free if you get other income off your tax return. So proactively planning your taxes can help you with the cash flow. Less taxes, you've got more money to spend from social. The other thing on Social Security is the full retirement age. And for most people listening, that's going to be probably age 67 nowadays. It used to be 65. It went up to 67. They're going to be making it, further out as time goes on. Full retirement age, if you start Social Security and you're not full retirement age, you got a couple of problems. And one is they're going to reduce your benefit, so you don't get the full amount that you were supposed to get at full retirement age. By the way, if you can wait past full retirement age, it keeps going up. So it doesn't go up anymore at age 70. But one thing is, what is your age? And if you don't need the money when you're younger, wait till age 70 to take the money, to take the benefit. And the reason is it'll be the highest possible you could get. And it'll have like this year, the cost of living was 8% increase, or some high number like that on Social Security. And as you go forward in time, once you're collecting, when they put the cost of living increase on your Social Security benefit, if you had a high Social Security benefit already, you're going to get a lot more dollars for that increase. So if you can, wait till age 70. Also, if you're married and you're the high income earner, that if you pass away, your spouse picks up automatically your benefit. They'll lose their benefit, but if your benefit was higher, they pick that up, including the future cost of living adjustments. that are going on. So that's one thing about age. And the other is going to be that if you're not full retirement age and you're collecting Social Security and you're working for income, like self-employed business that's showing a profit on the taxes, on your tax return, or you're on a W-2, an employee situation. So you're not full retirement age and you're still working for income, they're not going to give you the full benefit. They're going to reduce the benefit. There's a formula for every $2 over this threshold, they reduce one, and there's a formula thing that changes. But here's the words of wisdom on the financial housekeeping here for income and cash flow regarding Social Security. Plan your taxes ahead of time if you can, and if you don't need the money now, try to delay and wait till age 70. And a couple of fancy strategies and techniques for married people, special strategies called file and suspend. They're not as lenient as they used to be with that, but there's some pretty cool things you can do to take a look at Social Security planning your income. So I want to go on. The next housekeeping item on the 5 key areas of financial planning is taxation. And I want to focus the time today on the podcast on taxation because it's Thanksgiving time. When I'm recording this today, Thanksgiving is next week. It's the holidays for the fall and everything. And I thought I'd talk about Thanksgifting, kind of a word I just made up, but by gifting to charities with a special new law that's been around for a few years, but people still don't quite get it too much. They're starting to understand it. It's called QCD, or Qualified Charitable Distribution. So let's spend a couple of minutes on talking about Thanksgifting with Qualified Charitable Distribution. Now, the goal of this whole thing, if you're thinking this is, to wrap your brain around this tax law and the charity thing and how's it work tax-wise, there's a goal here. I think 2 goals. Number one is you bless a charity. If you're interested in that, you can do that. Of course, you could just write a check and bless a charity, but there's a special way to do this. If you do this QCD thing, that will end up saving you some taxes. And the goal is to reduce your adjusted gross income. If you have a tax return where you sign the second page, the usual 1040, it's usually the bottom number on the first page, adjusted gross income. It's like a threshold marker. If your adjusted gross income is low enough, there's some things you can do. If it's too high, there's things you can't do. So the goal is to try to reduce your adjusted gross income. Now, here's how it works. This is a rule that only applies to people who have IRAs. You can only do this from a distribution from an IRA account, and you want to give some money to a charity, but you'd like to reduce your taxes. You have to be 70 and a half years old the year that you do the distribution. This is not the RMD thing. Used to be age 70 and a half. They bumped it up to age 72, but they didn't change this area of the law. So if you're interested in doing what I'm going to talk about here, the QCD, you can do it if you're 70 and a half years old. And the idea is to get the IRA custodian, whoever's holding the money, to cut the check when you take a distribution, cut the check to the charity. Don't cut the check in your name. Cut the check to the charity. And if you do that, you got to do a little legwork here. So bear with me. It's not going to show up on your tax return because you're not getting the income as the concept. It's going to lower it. You can do this up to $100,000 per year per taxpayer. So if your married is $200,000, 100 for him, 100 for her, can come out if him and her have large IRAs, and you don't really want that money sitting there. Now, here's the cool thing. If you do this, get the custodian to cut the check to the charity, it counts towards your required minimum distribution, assuming you're 72 and you have to take the money out. So that's not an addition to. A lot of people in this age group are saying, well, why should I take this required minimum distribution, which you have to do to avoid the 50% penalty because you didn't take out enough money? Why should I put that on my tax return if I don't need the money? And if I'm going to give to charity anyway, I might as well have the custodian give the money directly to the charity so it won't show up on your tax return. Now, there's a weird thing here, a couple of things. Let me go into a couple of details. If the income does not show up on your tax return, then you can't write off as a deduction on Schedule A, itemized deductions. You can't write off a deduction because, you didn't give money to charity, the IRA did. The income is not picked up on your tax return. but the deduction's not given anyway either. But here's where my anyway thought came from. Most people who are in this age group are taking standard deduction, not itemized deduction. Matter of fact, I think somebody in this age group for 2022 or 2023, the standard deduction for married people is like $28,000. And if you say, well, if we give money to charity and that would be an itemized deduction, not standard, I get to put that on Schedule A and itemize it. And the IRS says, if it's less than $28,000, why are you bothering? Just take the standard deduction. What that means in English is if you're giving money to a charity, you're not able to even put it on your tax return to deduct it because you're taking standard deduction. That's where most people are. So if that's true, why not take money from your IRA and don't put it in your checking account and then write a check to charity because you can't write it off? Tell the IRA to cut the check to the charity. And if you do that, you're blessing the charity, but the income does not show up on your tax return. It lowers your adjusted gross income. You're better off in all ways to do these qualified charitable distributions. You still have a couple of weeks left before the year's over to work with your advisor, work with your IRA custodian to do a qualified charitable distribution. Now, here's a couple of things that some people don't know when you try to do these things, and these are special tips. Or better yet, maybe these are things that will trip you up. Instead of a tip, it's a trip. It'll trip you up if you're not aware of this. One thing is that you got to get a letter. Let me back up. 3 things I'm going to say here. Get the IRA custodian when they cut the check payable to the charity, and they don't need the EIN number. They don't need the tax ID number of the charity. I'll get to that in a second. They just want to know the name. So when they write that check, tell them to mail it to your house. You physically get the check in your hand and you deliver it to the charity. There's a reason why you would do this. And the reason is that when the IRS made these rules, they said when the IRA custodian cuts the check to the charity and then they have to tell the IRS and you that they kicked out the money, it's on a 1099. It's a form that says IRA distribution, taxable ordinary income. They're using your social number to do this. And it looks like you took the money and you have to pay tax on it. So if you don't remember you did a QCD, or you don't tell the accountant who's preparing your tax return that you did a QCD, they won't know. That's the tip, is you got to tell the tax preparer, here's my 1099 from XYZ IRA account I have, and it says that I took out $50,000, but $40,000 of it went directly to a charity through this QCD thing. So they're going to make that notation and adjustment on the tax return to make sure you're not going to get tagged and, you have to pay taxes on income that you didn't even get the income. The other thing here to make sure you're not getting tripped up, the other tip is you got to make sure the IRA custodian is going to hand you, and they might want to wait till next year when they start preparing these letters. It's a letter of saying thank you for your donation. It's got to say certain things, the amount of the money that they got that they're attributing to you giving it to them, how much money was that, and they have to make a statement on there. They're supposed to know all this stuff because they're a charity. They're told to do this, but they have to say on there that we got the money for nothing in return. Like if you gave them you gave them a donation and they gave you something back, they're supposed to say what the value of what they gave you back, so that you can't use that as a discount against the income. So get that letter, give it to your tax preparer before he works on your tax return, before he starts preparing it, so he knows it's there. If there's any kind of an audit or something, you've got the letter. Okay, I'm going to go on to the 5th area of financial planning. Hope you got your pen and pencil ready and you're still awake. I'm trying to make this as applicable and as exciting as possible, but the 5 key areas of financial planning ends up with investments, which is what we all think financial planning is about, is picking the right stocks and bonds and making sure our investments go up. So what's my key thing here? It's the 5th key area of financial planning, but what's my housekeeping end of the year tip to give you regarding investments? And I want to tell you that as I'm speaking today, the stock market, although it's been going up the last couple of days here, we just ended the midterm elections and all that stuff. It's not settled who's going to be in charge of the House and all that, but the market's still down 10 to 15%. It was down a lot more than that before. It's come back up a little bit, but it's a good idea to do some housekeeping, look at your portfolios and do rebalancing. Pretend, like you said, I'm supposed to be like 60% stocks, 40% bonds, whatever your plan and strategy was. Many of you listening, you know what I'm talking about. You've done that yourself on your 401k websites and stuff, or you're working with an advisor. The advisor is in control of helping you design that. I'm going to pick 60-40 as an example. If the market's down substantially and the bonds didn't really go down too much, they stayed relatively stable like they're supposed to, you might look at your total account and realize that you're no longer 60% stocks, 40% bonds, because the bonds didn't move too much and the stocks dropped. So maybe you're now, 45% stocks, which means 55% bonds. You're out of kilter. You want to be in a 60-40 kind of configuration. So if that's the case, your stocks went way down, you want to move some money to stocks, which is a great move because you're buying the stocks when they're down. And that's something that you should be doing. And the reverse is true if you have to rebalance the opposite way. You also want to avoid a high concentration of stock, like not too much money in one mutual fund, not too much money in one particular stock. In the news last week was crypto, like whoever the cryptocurrency stuff is, whatever that stuff is going on nowadays. One of the companies doing all that stuff, I think they went belly up bankrupt or something. That affected all the crypto. So somebody that had a whole bunch of money in crypto, they were taking the risk and they lost the risk because they lost that particular value. What they should have done maybe is when the thing went up and there was a lot of money there, let's diversify. Let's sell some of that stuff, pay taxes if you need to, but sell some of that stuff and diversify it into different kinds of assets, not all in one particular company or one particular mutual fund. The other big thing here to do is something that when the market is down, and this is the perfect time to be working with your financial advisor, to be talking about this if you're using a financial advisor, and that is called tax harvesting. So what you would do there is look at the accounts. This doesn't apply to IRA accounts and 401ks because there's no taxes on those things until you take the money out later. So these are the non-qualified accounts. They're not qualified for IRA tax treatment. They would be like individual accounts or trust accounts or joint accounts, anything at all investment-wise that is not in a tax wrapper. And the idea is to look and see, do you have any individual stocks or do you have any mutual funds that are low? You have what they call, it's called unrealized capital loss. That's saying that the statement you're looking at is keeping track that you bought that mutual fund or stock for a certain price, a while back. Now on paper, if you sold it, you're losing money on paper. That's a capital loss. That loss goes against your taxes. Maybe there's some gains in there. So if you sell some with a loss and sell some with a gain, then you're not going to have to pay tax on the ones that have the gain because you're balancing the loss and the gain off. It's called tax harvesting. When the market's down, can you sell some mutual funds or stocks that create on paper, on the tax return, a tax loss? And there's a lot of tips in there and everything that I don't want to go into here on this particular podcast because of the details. But it's something, if you're taking notes, talk to your advisor. Next week, call them and say, Happy Thanksgiving. Let's get together. I got a few things I want to talk about regarding these 5 key areas of financial planning. And one of those is going to be tax harvesting. Well, I'm looking at the clock here. I think that I want to go ahead and wrap it up. So I do want to thank you for listening to this episode of Householder Group's podcast of The Educated Investor. I've enjoyed speaking with you today, and I hope you've enjoyed listening. And if you found this material we spoke about today helpful, go tell a friend and be sure to cover items of interest with your financial advisor at your next scheduled review meeting. And you can locate and contact the independent, fiduciary, holistic Householder Group financial advisor nearest you at householdergroup.com. So, my friends, helping you onward and upward into and through your retirement dreams. This is your host, Jerry Blakely, wishing you all the best. Until next time.
The opinions voiced on this show are for general information only and are not intended to provide specific advice or recommendations for any individual, nor intended to be a substitute for specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to effect some of the strategies. Investing involves risk, including possible loss of principal.